All right, so in this video, I'm going to talk a little bit about incremental cash flows and some things that relate to that and some things that don't. So let's talk about sunk costs. Sunk costs are an outlay that has already occurred and which is not affected by the capital budgeting decision, and therefore it is not an incremental cash flow. Let me give you an example. Let's suppose you spent $1 million on some kind of feasibility study yesterday. And now, today, you are making the decision about whether or not to go forward with a capital budgeting project. Well, in that case, that $1 million you spent yesterday is not an incremental cash flow. You should ignore it. And the reason why is very simple. If you choose to pursue the project, that $1 million you spent yesterday. If you choose not to pursue the project, the $1 million was spent yesterday. And so if that's the case, the $1 million was spent yesterday no matter what, which basically means that is not affected by your decision at this point and is therefore not an incremental cash flow. So from that standpoint, basically with sunk costs, it's an outlay, it's already occurred, the money's already gone, and it is not affected by the decision, and therefore it should be ignored. Opportunity cost is looking at the cost of opportunities that are foregone to pursue a project. In other words, so if I give something up in order to do something, then that actually is going to be included. But sometimes it's included in interesting ways. So for instance, let me give you an example. Let's suppose you have a couple of things available to you, a couple of investment opportunities available to you. And let's suppose the second best option is providing an expected rate of return of let's say 40%. Okay. And let's say as not a lot of risk, but 40%. I mean, this is looking great. Well, if that second best option is providing a rate of return of 40%, let's say the best option has the same level of risk. In order for you to pick it, if you picked the best option, you would give up the second best option. So in order to pick that best option, it has to have a return that is better than the option that you gave up. So when you choose that best option, you are foregoing that second best option in my example. And that is incorporated in your decision. In this case, it's incorporated in a way in which you require that better project to offer something better, basically. So I'm going to factor in that, like, if I had to give this up, then whatever I am doing better be an improvement on that. So that's just, sort of one way you have to kind of think about what am I giving up? Whatever I'm choosing better be an improvement on whatever it is I'm giving up. And that needs to be factored in and incorporated in the decision. Okay, so for externalities, let's talk about this a little bit. This is the effect of a project on other parts of the firm. So for instance, one particular product cannibalizing the sales of another product. So in other words, if I have a company, I'm going to launch an improved product, and basically it's going to cannibalize the sales of another product. That's sometimes an incremental cash flow and is included, and sometimes it is not incremental and should be ignored. So let me give you a couple of examples. Let's suppose in scenario one. So for scenario one, let's suppose if I launch this product and it kills off the sales of my prior product. So basically, nobody buys my old product anymore. But if I do not launch my new product, I continue to sell all those same units of the old product. Well, if that's the scenario, then I should factor in that when I launch the new product, it's going to drive away the sales of the old product. And I need to factor in those lost sales as part of the analysis. On the other hand, let's look at a second scenario. Scenario two, if I launch a new product, it destroys the sales of my prior product, right? Because everybody wants the new model. All right. But if I don't launch the new product, my competitor's product destroys the sales of my old product. So if that's the case, if that second scenario is the case, then what's going to happen is basically that's no longer an incremental cash flow, because either way, whether I launch the new product or whether my competitor does it, those sales of the old product are going to go away. So if that's the case, then those externalities would not actually be relevant to the analysis. So you have to look at the scenario specifically when determining that. But ultimately, what you're looking for is the incremental cash flows. Hopefully this video has been helpful. Thank you so much for watching and have a great day.